A few weeks ago on the channel, we took a look at what stocks these politicians were buying, and in particular, our main focus was on Nancy Pelosi, who seems to have an incredibly great rate at buying companies which tend to perform incredibly well. Now, today's focus, we are going to take a look at Broadcom. It is one that she actually bought on the 24th of June this year, and she did publish this on the 3rd of July. As always, politicians do need to disclose companies that they have been buying, and it is estimated around 1 to 5 million worth of shares. Now, with this company, and in fact, since she did buy, as we can see, just over the last 30 days, this company is up 15%. And interestingly, we note that Wall Street does consider this a strong buy, and Seeking Alpha gives it a buy. Now, today's episode, we want to understand, is there still room to buy this company as it is about to have a stock split, making it more attractive for investors who do like to buy and they can't buy fractional shares. One thing to note, that when the market did close on Friday, a 10-for-1 stock split did take place. Therefore, as the share price we see now in today's analysis is $1,700, it will open this Monday at $170. So as we go through our analysis today and we look at our valuation, bear in mind to divide this by 10. Effectively, your dollar amount won't change if you are a shareholder of Broadcom. You will have 10 shares as opposed to 1, and as we mentioned, they will be trading for around $170. So let's find out whether or not we believe this a strong buy and follow in the footsteps of the great investor trader Nancy Pelosi. Now, when we take a look at the dividend safety score, it does sit at 67. It does look to be safe, and as we will cover in today's episode, they have an incredibly great growth rate for their dividend, double digits pretty much every single year. Now, one thing to bear in mind, it was reaffirmed last month that their dividend safety score does look to be safe. What this means, essentially, their dividend cut is unlikely. Now, how did they perform in the last recession? For those that do see one inbound, well, they ultimately had pretty much the same recession sales as the S&P at around -12. As we mentioned, dividend growth consistently very high year on year, double digits, and when you do zoom out over the last 10 years, they have increased this dividend by 36% on average year on year, and in fact, they have been increasing the dividends for the last 13 years. Now, one thing that we like to look at on this channel is dividend yield theory. Now, what it states, for those that are maybe new to the channel, that a company is undervalued when the current yield sits above the 5-year average. So in today's episode, we do have an overvaluation signal. The yield is much lower than the 5-year rolling, and the same to be said on the forward P. It is much higher than the 5-year, as well as sitting higher than the information technology sector. Now, bear in mind, whether this shows overvaluation, undervaluation, or even reasonable valuation, we don't look at any of these models in isolation, and we do tend to conclude towards the end. As always, we focus on the free cash flow payout. Below 50% is our preference for the industry specific of semiconductors, and that is what it has been every single year over the last 10-year period. Over the next 12 months, expected to come down to 35%. One of the reasons why they do continue to offer some very large increases to their dividend. Another thing we like about this company, those free cash flows tend to increase year on year, a very good sign. $3 in 2014, $43 in 2023, and expected to continue onto a very strong run over the next 12 months. The next thing that we always like to look at is the sales growth. Now, we will come on to this later in the episode, but 3 to 7% is what we want to see for the majority of companies. Pretty phenomenal across the board, in fact, 21% in 22, 8% in 2023, and when we do zoom out to look at it numerically, we can see some tremendous growth over the period. Now, one thing to note with all companies, there is no company within your portfolio or that is out there in the S&P or anywhere that is completely perfect. As you can see with Broadcom, they would have diluted your position as a shareholder over the last 10 years. But as we are about to see, the performance of the share price return over the last 10 years is absolutely incredible, probably why you wouldn't really care about this share dilution. We then move on to the ROIC. As always, a phenomenal metric to look and go through your own portfolio, screen them to see if they're getting at least 10% or more, give you faith management are effectively able to allocate on their capital. And what we can in fact see here, above 12% for the semiconductor industry, very nice over the last 2 years, and even on a trailing 12-month basis, that 10% is something ultimately we want to see as a minimum. On top of increasing the top line revenue, we always want to see operating margin where possible increasing as well, and we notice with Broadcom that operating efficiency increasing over the longer term. Great sign to see. And again, free cash flow margin, this is a free cash flow machine. Look at that in the low 50s over the last 4 years. Absolutely phenomenal. Not something we see on a day-to-day basis when we do come and review companies. Finally, the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Below 1.5 is what we want to see. Remember, as always, this metric correlates to dividend safety, balance sheet strength. 1.1 in 2023, which is good. Expected to climb over our 1.5 that we want to see at 1.85. Probably why we do get a safe dividend score as opposed to ultimately the very safe. But given the fact the free cash flow payout does look to consistently be below 50%, no worries whatsoever. Again, just something to keep an eye on. Now, before we continue, just to let you know, we've released our latest free weekly article. We run through 18 undervalued dividend kings. With this article, you also get a free spreadsheet running through all of the dividend kings, whether or not we see them as buys and our price targets. And as always, it does give you instant access to all of these other articles, and we are dropping our next article tomorrow morning. So continuing with this company, as we mentioned, just over the last month, up 15%. Year to date, very strong, up 52%. Over the last year, up 91%. And again, if you've been a shareholder over the longer term, probably one of the best in your portfolio, up over 2,000%. Now, as we mentioned, it is trading towards the upper end of the 52-week range with the strong buy from Wall Street. In terms of the yield, as we saw, 1.23%, lower than the 5-year average. Forward P sitting at 35.44, again, much higher than the 5-year rolling. Now, in terms of looking at these companies' numbers, as we did see, we want to look at both revenue and bottom line net income. Over the last 10 years, it has grown phenomenally and consistently as well, something we always like to see here on the channel. 4.3 billion in 2014. 36 billion in 2023, and on a trailing 12-month basis, we can see and expect the full year accounts for 2024 to be very strong as well. No surprises is the prediction. Then when we look at the bottom line net income, 263 million in 2014, 14.1 billion in 2023, and whilst it does have a little bit of inconsistencies, noting the net loss in 2016, we still see over the longer term it is moving in the right direction, and as always, it is important when they do release their earnings to look forwards towards their guidance. Now, in terms of the health of the company, as always, total cash versus total debt, their cash position has increased rapidly, 1.6 billion in 2014, 9.8 billion in their latest quarterly report, and again, similar to pretty much every other metric, it has been increasing over the longer term. It is important to understand, though, that these metrics, in fact, the cash on its own, doesn't really tell us anything, which is why we always combine it with their total debt, which, as we can see, has also increased rapidly. 5.5 billion in 2014, 74 billion in their latest quarterly report, which is why we did say something just to keep an eye on. That net debt to EBITDA metric is also climbing. Not something I particularly like to see, especially given the fact it has pretty much, or in fact nearly doubled just from 2023 to the latest quarter. So as always, there are things with companies that we do need to take into account, and we can factor that in to our margin of safety later on. We then look to see how they've performed historically, earnings per share, as well as their forward guidance. What we know, very strong. Their last 4 quarters they have beaten, so a 100% track record. And over the next 4 quarters, they are estimating double-digit growth year on year to the earnings per share. And for those that do like to zoom out, 60.93 is their EPS estimate for October 2025, which will bring that forward P down to around 27.91. So looks good historical performance as well as their estimations. Again, it will depend on the confidence you do have in them to hit those targets. We then move on to the valuation grade and underlying metrics. Now they do get an F, no surprises here, because when we do look at the P on a non-GAAP basis, much higher, 35 versus the sector median of 25. In fact, you are paying a premium as opposed to the sector median of 42%. As always, you could justify it is warranted to pay a premium. The real question is, what premium does a company like Broadcom deserve? And we will come across that later on. Pretty much then the consensus here, whatever metric you use to evaluate a company, Broadcom is trading significantly higher than the sector median. We then move on to their growth grade, where they do get a B. Year-on-year revenue growth, again, we can see now why it does trade at a premium, much better at 22% versus the sector median of 3.28. Pretty much expected the same growth over the next 12 months, a lot better than the sector median of 7%. And one of the things we always draw your attention to, earnings per share over the next 3 to 5 years, 17% anticipated compounded annual growth. The sector as a whole, 14.2. So looking pretty good on the growth aspect. And when we get to the profitability, well, they get an A+ here. Incredible gross profit margin, 74% versus the sector 49%. Incredible bottom line as well, 24% when you consider the sector median as a whole is 3%. That is an incredible sign. And cash from operations, that just looks ridiculous. Under 19 billion, where the sector median 95 million. So again, it does make sense why this is trading at a premium. And in conclusion, for this part of the analysis, a buy from Seeking Alpha, a strong buy from Wall Street, a hold from Quant, an F on valuation, a B on growth with an A+ on profitability. Now, how have they performed? Are they a very strong performer in relation to the market, in relation to their competitors? Well, we have TSM, AMD, Qualcomm, some very big names. Every single one of these we have reviewed on the channel. Over the last year, now bear in mind, includes reinvesting dividends, Broadcom is actually the second best performing, which does go to tell us quite a lot. The industry as a whole, which shouldn't be essentially news to anyone, has performed very strongly, up 94%, TSM 83%, and we see the real leader here, MU, up 110%. We then move out and zoom to the last 5 years, and we actually see Broadcom by quite some distance has performed a lot better. But when we look across this whole industry as a whole, maybe other than Texas Instruments, has performed phenomenally. And over the last 10 years, we can see that actually Broadcom, whilst performing incredibly at over 2,800%, is in fact second to AMD, which is right there at 4,641. Now, these are all great to look at. It is historical performance, and future performance isn't relevant to that, but something we just like to incorporate. The main question I would focus on is, do you believe over the next 10 years, or whatever your investment horizon is, it will outperform the S&P? Otherwise, as always, low-cost ETF will be the solution. So over the last year, S&P has significantly underperformed Broadcom, but as always, to be fair, 26% just year to date is very strong. Over the last 5 years, again, S&P has underperformed, and over the last 10, again, the same result. Interesting though to know your thoughts if you do believe that will continue over the next 10 years and beyond. Now, before we look at the valuation, 2 parts to note. Firstly, insider ownership, 2% with 92 million worth of sales over the last year. We see a little bit of buying in relation, 10.45 million, again, over the same period. And in all honesty, there is a trend where every single quarter insiders are selling, so maybe it isn't something to be surprised about. And when we take a look at who these are, we can in fact see the director did sell in 2 tranches, 10th of April as well as the 20th of June. As always, not a bearish indicator for us. Insiders will sell for reasons we have no clue about, whether it's personal or financial. We then move on to institutional ownership, just over 76%, 6 billion worth of sales over the last 12 months, a lot more buying over the same time period, as we can see. But when we do focus in quarter 2, we actually see more selling than buying, the opposite to be said for the previous quarter. Now, as always, do take all of this information in your own investment thesis, but just remember to always do your own due diligence, never copy institutions or essentially insiders. In fact, don't even copy Nancy Pelosi as well. Always do your own due diligence. Now let's get into the valuation of this company. Our intrinsic value is $1,654. The way we got to this number, when we look at the DCF model, we've used 3 rates, a low, medium, and high. Effectively, we've gone for a 15% rate, which is below the average growth, which is very high at 48%. And we can see the free cash flow year on year. We've then used this with the discount rate to get the present value of future free cash flow and terminal value. We've added with the cash, subtract total debt, got to the equity value, divide by the shares outstanding, and we can see if you do believe a median rate is applicable, right now that means implied downside of 3%. Now, people will say that is way too conservative, especially with the way AI is going. Semiconductors are going to be going really, really high for quite some time. As we have looked out on the channel, around 30 to 45% compounded annual growth rate to the top line, at least over the next 10 years. Again, from articles from Bloomberg, as well as PwC and some other big names. So again, for those that do see, 15% too low, 20% as we can see here, 2395 would give upside of 41%. Again, there will be people who say that is still a little bit conservative. At 25%, we can see, in fact, pretty much double. So if you're someone that believes 25% will be the growth rate over the next 10 years and beyond, this company is having an intrinsic value of $3,400. As we said, double the current trading price. Again, you can grab a copy of this model by clicking on the pinned comment below, putting in your own numbers, whatever you believe, whatever your investment thesis does hold. But as we said, we're going to take the median rate of 15% to the intrinsic value final calculation, and we can see 1654 is what we believe with the current price at 1,700. So whilst we always like to use a margin of safety of 10% and we execute on that when it meets our 3 golden criteria, that is a wide moat, strong financial metrics and good forward looking data, you would have to wait for around $1,000, say $500. Bear in mind when the market opens it will all be divided by 10, so this will be around $150 as opposed to the $170 it will be trading post split. Again, there will be people who will be happy to buy this with a margin of safety of 5% or even at its intrinsic value, but as we said, we do believe it to be marginally overvalued in today's market. In terms of Wall Street, well, as we can see, very bullish still. They have upside of 14%, $1,937, and this will be around $194 as the market opens. As always though, let us know your thoughts in the comments below. Did you buy when Nancy bought? Is this one you've maybe bought previously? It's on the watch list, or maybe you believe it is heading towards the top and you are looking to sell. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.